Okay, so we all see the stock market around us, right? It's this massive, nonstop engine of buying and selling. But have you ever stopped to think, when you buy a share of a company, where did that little piece of the company actually come from? Let's dig in and trace it right back to its birth.
You see those stock tickers scrolling by on the news all day long? But behind every single one of those trades is a share of a company, a share that had to be created somewhere at some point. So the real question is, when that share was first sold, where did the money go? The answer to that is everything. It's the key to understanding how companies use the stock market to get huge.
All right, to figure that out, we've got to go back to the very beginning. We need to visit the birthplace of a stock. This place is called the primary market, and it's really the first chapter in the story of any company you see trading today. So, to make this super clear, let's invent a company. We'll call it Future Gadgets, Inc. Imagine they've just created some game-changing new device. But to actually build it for everyone, build factories and scale up, they need a ton of cash, like a massive amount of money. This is where Future Gadgets decides to go public. They do this through what's called an initial public offering, or an IPO. Now, this is a huge deal. An IPO is pretty much the one and only time a private company gets to create brand new shares out of thin air and sell them to the public. And why do they do it? For one reason and one reason only: to raise that cash for the company itself.
The whole IPO journey is actually pretty straightforward when you break it down. Step 1. Future Gadgets knows it needs money to grow. Step 2. They work with big banks to create these brand new shares, these little slices of ownership that literally did not exist a moment before. And step 3, this is the most important part, right here. The money from selling all those new shares, it goes directly into Future Gadgets' bank account, not to anyone else, to the company.
The best way to think about this, it's like a car dealership selling a brand new car fresh off the assembly line. When you buy that car, your money goes straight to Ford or Toyota or whoever made it. The company that actually built the car gets paid. That's the primary market.
Okay, so Future Gadgets has its money. They're off building factories, hiring people, and growing like crazy. But what about all those shares that people just bought? Well, now they enter a whole new world. This is the world we all know and see every day, the secondary market.
Yep, once that IPO is over, Future Gadgets is pretty much out of the picture for a while, focusing on its business. Those shares they created, they now have a life of their own, ready to be traded again and again and again. This right here is what we usually just call the stock market. The New York Stock Exchange, the Nasdaq, all of that. The most crucial thing to get about the secondary market is that it's just investors trading existing shares back and forth with each other. The company, Future Gadgets, they're not involved. They don't see a dime from these daily trades.
And this is where our car analogy really clicks into place. The secondary market, it's the giant used car lot of the world. Think about it. If you buy a used Honda from your friend down the street, does Honda get any of that money? No way. The cash just goes from your wallet to your friend's wallet. That's it.
So there you have it. Two totally separate markets, each with a completely different job. Let's put them side by side, because when you do, the difference becomes crystal clear.
Okay, this chart just lays it all out perfectly. Let's walk through it. First, the purpose. The primary market's whole goal is to help the company raise money. The secondary market, that's for investors to trade assets. Now here's the big one. Who gets the money? In the primary market, the cash goes to the company, but in the secondary market, it goes to the investor who's selling their shares. The money flows in two totally different directions. It's that simple.
So why does any of this actually matter to you? Well, because it helps you make sense of the financial news you see every day. When you hear about some hot new IPO, you'll know, that's a company raising brand new money to grow. And when you see the Dow Jones or the S&P 500 bouncing around all day, you'll know that's just the secondary market, investors trading existing shares among themselves. And to make it even easier, I've got a super simple checklist for you. You can use this anytime you hear about a stock sale to know exactly what's going on. Really, all you have to do is ask one of two questions. First, is the company itself selling new shares to get cash? If the answer is yes, boom, that's the primary market. Or, are investors just trading existing shares back and forth? If yes, that's the secondary market. See? Super straightforward.
All right, we've gone through a lot, but it all really boils down to just a few key ideas. So let's lock in our 3 big takeaways for today, just to make sure this all sticks.
Okay, here we go. Takeaway number 1. The primary market is for funding companies, period. Its only job is to get money into the hands of businesses that want to grow. Number 2, the secondary market is for investors. It's the playground where we all get to buy and sell those shares from each other. And finally, number 3, and this is really important, they're two separate markets, but they're part of one connected system. Think about it. The primary market creates the stocks, and the secondary market is where they get traded. You can't have one without the other. Nobody would buy a new stock in an IPO if they didn't think they could sell it later, right? They need each other to work.
All right, so now we know where stocks come from and where they live their lives. But with millions and millions of trades happening every single day across thousands of companies, how on earth do we get a quick snapshot of how the entire market is doing at any given moment?
Well, that question is the perfect setup for our next explainer, where we're going to dive into market indexes. We're talking about the S&P 500, the Nasdaq, the Dow, all those names you hear all the time. We'll break down what they actually are and what they tell us about the economy. So make sure you follow along so you don't miss that one.
And of course, just a quick reminder, all this is for educational purposes. It is not financial advice. Please do your own research.